What's the difference between investing and speculation? We'll learn more about that and a whole lot more on this edition of Money in Your Pocket. Dr. Patrick Lach returns to talk to us about alternative investments, including gold, real estate, franchising, hedge funds, and collectibles. We'll learn about the pros and cons of these investment strategies and who they are best suited for. That's just ahead on this edition of Money in Your Pocket.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
Thank you so much for joining us for Money in Your Pocket. I'm your host, Lori Banks, and Dr. Patrick Lach from EIU School of Business and an investment advisor joins us today. Thanks for coming back.
Thanks for having me.
Well, today our topic is alternative investments, and we'll get into what those are in just a few minutes. But who out there is a good candidate for someone to look at alternative investing?
Well, a good candidate, in an earlier show this season, we talked about first financial steps. We talked about maxing out a 401k, saving 15% for retirement, knocking out debt. And somebody that's done all those things, they've been saving for a while, they have a really good nest egg, and they're to the point where I call it a glide path, where you have an idea of where you want to land in retirement. If you have a reasonable glide path of you meet with an investment advisor and that person should help you compute what you would need to save per year. But if that's a very achievable goal, then and only then would I say move on to alternative investments. Okay. But for the most part, a portfolio of stocks and or bonds, I don't think there's anything out there that beats that combination.
So this is for our people who have, again, checked the many things off their list. So we're going to go through a few of them. The first one is gold. And I see commercials on TV, hear ads on the radio for invest in gold. What do we need to know about investing in gold?
Number one is that you can't.
Okay, why not?
Well, investment is, we invest when we take cash and we use that cash to build a good that we're going to sell for more cash, or we're going to use that cash and use it to provide a service, which will generate more cash. That's investing, when we use cash and we put that cash to work to get more cash. When we buy gold, we're buying a big chunk of metal. People usually buy these in 10-ounce bars, but when we're buying gold, we're buying a 10-ounce bar and we're crossing our fingers that it goes up in value. That's not investing. That is speculation in its purest form. Another word for speculation is gambling. So when you're buying gold, you're hoping the price is going to go up, and may or may not go up depending on the price. You know, the market for gold has been historically, at least over the last 30, 40 years, all over the place.
Okay, yeah, because it was really high not too many years ago. Where is it at now?
Well, it peaked at $1,900 an ounce back in August of 2011. As we're recording this, gold is trading a little bit less than $1,100 per ounce. So that's a pretty big loss in a relatively short period of time.
So if you compared the stock market with the gold market and line the graphs up like this, how would they compare?
What's interesting is gold, your return, very, very long term, expect to get about 4% long run. Stock market, which we'll call the S&P 500, I could probably do a whole nother show about what is the market, but let's say it's the S&P 500. S&P 500, you're going to average about 10% over the long run. And what's interesting is gold prices, although it gives you a return only a fraction as much as the stock market, in some cases, gold could almost have as much fluctuation as the stock market. And it gets even more, the argument in favor of stocks over gold becomes more pronounced when you look at best and worst, say 15-year periods or 20-year periods. So everybody people that are big advocates of gold like to remind you that if you bought in 2000, that it was about 300 an ounce in 2000, and now you're still up threefold. But Those people don't realize if you go back to 1980, gold was at $8.50 an ounce. So if you bought in 1980 and held to today, your return is incredibly small. In fact, if you bought in 1980 and you held for 20 years, it went from $8.50 in 1980 to about $284 an ounce in 2000. That comes out to a compound loss of 5.3% per year. To give you a comparison of the S&P 500, the absolute worst 20-year period in the S&P 500's history, you had a positive return of 1.89% per year. And by the way, that assumes you bought in September right before the stock market crashed.
All right. So I know we talked about a Gallup poll about how Americans feel about gold, because we tend to think, oh, gold, we use the gold standard, it's, you know, it's valuable. How do Americans feel about gold?
It's interesting. It, of course, varies, but in August of 2011, when gold was at its peak, people were asked, what do you think of, people were asked, what is the best long-term investment? Number one answer was gold at 35%. And what's interesting, and gold is a fear-based move, in my opinion. I'm a big believer that one of the things I love about investment markets is it's an exercise in applied social psychology. You could really see how people are feeling based on the movements of stocks, gold, bonds, etc. But gold is really a fear-based move, and a lot of people got out of stocks because they were scared of what happened after the tech bubble, and so many people bought in at the peak of the tech bubble, rode it all the way down, got scared of that drop and said, to heck with this, I'm going to gold. This gold's been going up and up and up. And a lot of people got in gold at 1900, and that was August of 2011 when 35% said gold, best long-term investment. Real estate was the number 2 answer. Stocks was the number 3 answer. Only 17% of people in August of 2011 said stocks are the best long-term investment. What's fascinating, since then, we have gold and stocks. In the years or the months since August of 2011, stocks are up 80%, gold is down 40%.
Okay.
So that's a huge difference in performance. And I think it goes to show you that what feels safe at the time is very seldom safe or a good idea in the long term.
So gold prices are, if they're down, they're good if you're buying jewelry and engagement rings and things like that.
Exactly.
Not good if you're an investor.
Exactly.
Anything else we want to talk about gold before we move on to real estate?
Well, like I said, gold it's a fear-based investment, but it's also, a lot of people will criticize me when I say that I'm a big believer in a portfolio of stocks and or bonds, depending on the client. But a lot of people say, man, that's so boring, and it is. And there is an allure to gold. There is something to be said about having that shiny chunk of metal in your hand. But I tell people your retirement portfolio is no place to go for adventure. If you want adventure, you know, go skydiving, go bungee jumping. Don't look for adventure with your life savings.
All right, so let's move on to real estate. I mean, I'm originally from Minnesota, and for a while in Minnesota, lake shore property was going up and up and up, because up there we say they're not making anymore. So buy land because they're not making anymore. Does that make real estate a good investment?
Well, real estate, a lot of money can be made in real estate, but in my opinion, when it comes to real estate, a lot of people overestimate the benefits and underestimate the downside of real estate.
Okay.
So the problems with real estate, number one, it's very difficult to diversify because real estate is so expensive. With stocks, you could, through a mutual fund or something called an exchange traded fund, for a few $100s, you could own a portfolio of 10,000 stocks. But with real estate, you need, at a minimum, $50,000 for one property. So big problem number one, it's very difficult to diversify. Problem number two, the transaction costs are astronomical. If you have a $120,000 mutual fund portfolio and you wanted to sell it, most brokerage firms are going to charge you $25 to liquidate $120,000 stock mutual fund holdings. If you want to liquidate a $120,000 property, you're looking at, after realtors' commissions, closing costs, almost 10% of the value. So selling $120,000 worth of stock mutual funds, $25. Selling a $120,000 piece of real estate, $12,000 in transaction costs. So those to me are the two biggest disadvantages of investing in real estate. And of course, the other issue is with real estate, man, there's a very, very high hassle factor involved. If you're thinking of buying rental real estate as an investment, ask somebody that has rental real estate and ask them to tell you about their worst tenant and be ready for a barrage of nightmare stories. So the upside of real estate is the cash flow aspect. People will say, if you're in retirement and you have a paid for piece of property, that rent is money that you could use to pay your day-to-day living expenses. The flip side of that is real estate has a high hassle factor. If somebody's furnace goes out on Christmas Day, you've got to address that issue. And the other issue with real estate, I own a condo in Louisville, Kentucky, and recently my furnace went out, and that's going to be $3,000 to replace it. So if you have a rental property and a furnace goes out, you need to be able to write a check for $3,000. And that's the other big downside of real estate is occasionally you need to write a big check to keep that real estate portfolio going. On the flip side, my stock mutual fund portfolio has never asked me to replace a furnace. It's never asked me to write a $3,000 check. I put my money into the mutual funds and I don't have to do anything else.
What about, you said that you actually own a piece of commercial real estate.
I do.
Are there some benefits to owning commercial real estate versus like apartments and condos?
I think the commercial real estate side, it's a much lower hassle factor. I almost think of it as real estate light because you're dealing with tenants, but you're typically dealing with business tenants who, the office is gonna be tidy because that's where they meet with clients. The other advantage is I'm probably not gonna get a call on Christmas telling me about a furnace being out because more likely than not, nobody's gonna be in the office on Christmas. So from that regards, it's a much lower hassle factor. And another issue with residential real estate is if you do have a bad tenant, the laws naturally are tilted in favor of the tenant. The laws are set up as such that we want to make sure we're not throwing somebody on the streets. Whereas with a piece of commercial real estate, it's a place of business. The laws aren't quite as stringent on, it's much easier in commercial real estate to get rid of a bad tenant if for some reason you get a bad tenant.
Okay, so what about real estate that doesn't involve a building, like land or lakeshore property or?
Once you do that, you're right back to speculation. If you're just buying the property and hoping it goes up in value and you're not going to do anything on the property, you're not going to improve it, you just buy the property and you hope 5 years from now somebody will give me double what I paid for it. Again, you're getting back into speculation, which, although like you said, you've eliminated that high hassle factor, but you're back to speculating, and once again, you're investing a huge chunk of money into one property, and you could be in an area where property values go down, and that's another big risk of investing in real estate.
All right, so let's move on because I want to get through all these today. Let's talk about franchising.
Sure.
First of all, explain what franchising is.
So, for a lot of our, you think of restaurant where you like to frequent, or any sort of business where they're all over the place.
Right. Like a McDonald's or something like that.
Exactly. Yeah. That would be an example of a franchise. And most fast food restaurants and even a lot of sit-down restaurants are not owned by the corporation, they're owned by private individuals. So the advantage of that for people, some people say, I always wanted to start my own business, but don't really have a blueprint of how to get started. And of course, if you purchase a franchise, typically the corporation will lay out, this is exactly what you do. A lot of times the corporation will tell you, this is the best place to set up the franchise. There's a lot of benefits that you get from the corporation. The flip side is hassle factor is even higher than real estate. And you're also really at the mercy of the corporation. I won't get into specific examples, but there's been a few instances the last couple of years, heads of major corporations have made some controversial political comments that's resulted in a loss of revenue for those businesses. And how frustrating would it be to be a business owner and all of a sudden your sales dry up because of something somebody else said.
Well, and I imagine being a franchisee is not a cheap thing to do when you're part of a large franchise.
And you talk about some of the more well-known franchises. The more well-known and established a franchise is, typically the more expensive it is to buy in. And some of the more established franchises, it could cost you $1 to $2 million just to get in. You usually have to have $250,000 to $500,000 in liquid capital. And man, talk about putting all your eggs in one basket.
Right.
It becomes very, very risky, which is why I tell people, only do things like real estate or buying a franchise. I don't think there's anything wrong with it. In fact, honestly, I think it'd be pretty cool to own a franchise one day. But I would only recommend doing that if you have, again, your financial house in order. You have a portfolio that's gonna give you enough income to meet your goals in retirement. So if you have retirement taken care of and you want to invest in something that's a passion, then in that case, buy that piece of rental property, open up that franchise you've always dreamed about. But I wouldn't make that my primary savings vehicle because there's just so much risk involved.
Yeah, there's no such thing as a sure thing, is what you're
No,
saying.
exactly, exactly.
All right, let's move on to this one, hedge funds. I've heard of it. I have no idea what a hedge fund is.
Hedge fund is very interesting because the name is such a misnomer. Hedging actually refers to mitigating risks.
Okay.
So you've heard the term hedge our bets. You know, you better hedge your bets.
Yes.
Hedge your bets means that you're reducing the risk of a bet. I'll give you a quick example. A few years ago, Auburn played Florida State for the NCAA football national championship. Before the season started, an Auburn fan bought, he bet, I think it was $1,000 on Auburn to win the national championship. Nobody thought Auburn was going to go very far. So the odds were 250 to 1. So by having that ticket, I believe it was going to pay him, I think it was something around $250,000 if Auburn won. One way he could have hedged his bets was going into that national championship game. He could have made a large bet on Florida State, maybe bet $125,000 for Florida State to win. That way, if Florida State wins, he gets $125,000. If Auburn wins, he still nets $125,000. So hedging would imply that we're mitigating risk, but hedge funds are actually insanely risky. And the reason they're called hedge funds is the managers are actually trying to hedge the risk of the overall market and isolate the risk associated with an individual company.
Okay.
So hedge funds could be incredibly risky, and they're often marketed as an avenue for the wealthy or sophisticated investor. They typically have very high minimums, often $1 million or more. And in my opinion, they're just not a very good investment.
Okay.
Issue number one, the fees are astronomical. They typically have what's called a 220 fee structure, which means you're charged 2% of what you have invested in the hedge fund plus 20% of any profits that they earn for you. And of course, the hedge fund won't charge you on the same profits twice. So if you invest $100,000 and the hedge fund earns, say, 40% in a year, now you have $140,000. Well, it's a $40,000 profit. The hedge fund's going to take 20% of that, which would be $8,000. They're going to charge you a 2% fee on the $140,000. That's $2,800. So it went up to $140,000. It's down to less than $130,000. So because of all the fees, that 40% turns into a 30% fee. And the high watermark says they're not going to charge you performance-based fees again until they go over $140,000. And what happens all too often, Andrew Ng from Columbia reports that every year, approximately 10 to 15% of hedge funds close their doors. The theory is that they've hit that high watermark and seen a drop in performance. And rather than getting all the way back to that high watermark with none of those 20% performance fees, they say, to heck with this, they shut down the hedge fund and they open up a new hedge fund.
All right. So it sounds so far like gold, real estate, franchising, and hedge funds aren't really all they're cracked. I mean, you kind of got to know what you're doing, and it's not something to do if you've got not a lot of money to work with.
Exactly.
All right, so let's talk about one that maybe more people can relate to. I don't know that a lot of viewers can relate to hedge funds, but collectibles. Baseball cards, sports memorabilia, antiques. I mean, we've all seen probably Antiques Roadshow, and this painting is worth, $10,000 that you bought at Goodwill. Are collectibles a good investment?
Again, with collectibles, they're not going to do anything to generate cash. You buy them and you hope they go up in value so you could sell at a higher value. So once again, we're back to speculating, just like with...
It's like having a hunk of gold.
Exactly. So that's issue number one. I will say if you have a large degree of knowledge in a particular area, there is the potential to make a little bit of money, but people forget about the cost of their time that they spend, combing the ads for the next best deal, traveling around trying to find that, undiscovered gem, that, car that's been sitting in a garage that's worth $40,000 and the owner's going to sell it for 10. There's a lot of work involved in that. So once again, we're back to a very high hassle factor. And although there's money to be made, if you really, really know that area, it's a very time-consuming commitment. And people will look at, well, I bought this for $500, I sold it for $1,000, I made $500. But if they could have been working and earning $25 an hour and they've spent 100 hours finding that undiscovered gem, they really are better off just going to work and working some overtime.
Right. And you also mentioned too that sale of collectibles, you're going to pay a higher tax rate. I need you to explain that.
So if we buy a stock and we hold it for what the IRS considers a long-term gain, that would be greater than 1 year. I always tell students a long-term capital gain is one that's held for a year and a day or greater. So if we have a long-term capital gain with a stock or a stock mutual fund, for most people, and when I say most, excluding the top tax bracket and the bottom two tax brackets, for most people, you're looking at a 15% long-term capital gain. For a collectible, you're looking at a 28% tax on any gain that you get from those collectibles. So that extra 13% is going to eat into your profits pretty quick.
So it sounds like collectibles, if that's something you just have a hobby and you enjoy it, do it for the enjoyment. I've always said this pen could be worth $1,000, but it's only worth $1,000 if I can find someone to pay $1,000 for
Exactly.
that. So Patrick, we've got about 1 minute left. I need you to sum up what we need to know about alternative investments. What's your last bit of advice?
Number one, make sure you've got your house in order. I always use the analogy of, when you're a parent with kids, or if you remember being a kid yourself, you can only have dessert if you clean off your plate. And I think it's the same thing with alternative investments. If it's something that's a passion, if you really enjoy gold or real estate, or you've always dreamed of owning a franchise, it's okay to do it, but make sure that you're debt-free, make sure you're saving for retirement, make sure you have a large chunk of change saved for retirement, and investments with a good long-term track record like stocks or bonds. If you've covered all those bases, if you've taken care of all your priorities, if you really want to buy some gold or buy some land or a franchise, or if you want to collect old cars, that's fine, but only after you've taken care of your priorities.
And remember too, if it says it's a sure thing, if it sounds too good to be true, chances are it might be. So you probably need to do your research and speak with an investment professional before investing your money in something you're not
Exactly.
sure about.
I tell people, only worry when you have it all if you think you have it all figured out, because if you think you have it all figured out, usually bad things are about to happen.
All right, we'll leave it at that. Thanks, Patrick, for coming by Money in Your Pocket.
All right, thank you.
So here's the bottom line when it comes to alternative investments. These type of investments are best suited for those who have their complete financial house in order. Each one comes with risks and rewards, and some have higher hassle factors than others, such as real estate. Having a thorough knowledge about the benefits and potential drawbacks is key, and each investment can have its own unique drawbacks, so do your homework. That's our program for this week. Tune in next time or check us out online anytime at youtube.com/WEIU-TV.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.